Okay, perfect. Well, it looks like it's 5 past. We want to be respectful of everybody's time. So let's get started. Welcome to all of you and welcome back to those of you who have been around with us for the past 4 years now. It's really nice to see some familiar faces. Today, we'll be focusing on an evidence-based approach to investing in this advanced investing session for young professionals. And so, our clients and our friends often ask us, what can I do to improve my portfolio? So our objective today is truly to cut through the noise and show you what is proven to work based off unbiased data. And so Jacob and I have been itching to get this one out there, and we're really, really excited. So thank you all for coming out tonight. With that being said, some relevant disclosures before I do get started. This workshop is for informative purposes only. So please do consult your financial planner before making any financial decisions. And in terms of independence and neutrality, today's course material has been developed independently. So this means the lessons and concepts you'll be learning today are free from any commercial bias, banks or insurance companies, as myself and Jacob are not employed by any of those companies. Okay, we got all that boring stuff out of the way. Let's dive into things here. So really, when it comes to how Jacob and I like to run our workshops, it's a little bit different. We want you to feel really comfortable, almost as if you're like at a cousin's house or a friend's house. And so you can just interrupt us at any time if you have any questions. We'd actually really like that. We do this just because we often find people learn best when they know they can stop and ask questions anytime. So feel free to really just stop us and ask us questions anytime. With that being said as well, please do keep your videos on if you're comfortable. We would love to just see people's reactions to the different things that we've created here. And lastly here, if you do have any questions and you don't want to interrupt us, feel free to type it into the chat and our moderator, Jordan, will get around to it eventually.
Nice,
the last note,
the
last note, I want to mention this as well. You might want to take notes or have screenshots ready into a Word document. So how you can do that is, let me actually show you using my keyboard. If you're a Windows user like me, go here, which is the window key, Shift and S, and then you can actually screenshot that way. You might see some interesting stats or facts on the slides here, and you might want to be able to save those. So hopefully that's a helpful tip. Mac users, I think it's Command Shift S. You can Google it, but hopefully that's a helpful tip before we get started here. Sorry, Jacob, was that what you wanted to say?
Yeah, pretty much. And also I'm going to say that we just want to emphasize that for you guys to learn the best, definitely feel free to send a message in the chat. And you can also send it anonymously if you're a little bit shy, directly to me or G directly. But if you are okay with it, you can send it straight to Jordan, because Jordan will be the one who's going to be monitoring the chat. So that'd be great. Thanks, guys.
Perfect. Thank you, Jacob. And so, yeah, let us give you guys a little bit of introductions in terms of who we are and why we're in front of you today. So my name is G. I'm an associate advisor with Financial Literacy Council. And financial literacy has been hugely important to us because we recognize that schools don't really teach these things yet. It's a fundamental building block of life. And so for this reason, our focus has really been centered on building financial literacy. And so you can see under Alpha's name some of the places that we've taught at. I also have 2 investment managers that help my clients shape their financial futures as well. And so for myself, growing up in Vancouver, I really noticed that some kids could go to church camp while others couldn't, or some kids could play club volleyball while others couldn't. And so I realize now that there may be 2 families with very similar jobs and similar incomes, but this family here may have made some adjustments early on in their financial planning process, and this may have resulted in a significant difference in their wealth, right? And then ultimately, as a result of that, they're able to live out their values. So this is what I noticed, and I really would love for people to look back at their life and think, wow, I'm so glad I had done these things, rather than thinking, oh, I wish I had done those things. And so today, the goal is really just to show you a few knobs that you can adjust immediately, resulting in this significant financial difference for your future as well. I'll let Jacob introduce a little bit about himself.
Thanks, G. Yeah, first of all, great to meet all you guys. This is me and G is one of our favorite things to do ever. So yeah, just so glad you guys could join us, and definitely don't hesitate to ask any questions if you have any. So for those of you who don't know who I am, my name is Jacob. And a long time ago, I was about 17 years old, and I came home on a very normal day just from school, and totally out of nowhere, I came home and my family was suddenly told that my dad was diagnosed with stage 4 liver cancer. And he was told that he would have just 2 weeks to live. And so that was very stressful. And eventually my dad did pass away. But what was more stressful is that my dad actually was the one who managed all our family's finances. And so when he passed away, we didn't really know what exactly to do. And as a result of that, what happened was we received a lot of really terrible advice from really great salespeople. And eventually, when we finally sorted everything out and the dust was settled, we made over $1 million worth of mistakes. And we also missed out on a ton of very big opportunities. And so today, I personally feel very convicted to teach classes like this that are based on proven processes that these mentors who are on the screen have taught me. And also, the idea is that we want to make sure that for you guys, as you guys go through your life, that you guys can avoid the same landmines that my family stepped on, and also take advantage of the opportunities that we didn't know about. And so today, G and I were excited to talk about investing specifically, because as you guys probably realize, for investing, it seems like everyone has an opinion on how to invest in those different things. But what's interesting is almost nobody has hard data on what actually works. And so that's what we're going to be talking about today. So first thing we'll mention is an evidence-based approach to investing, followed by some strengths and risks of this approach, some resources and citations if you guys want to do your own research, and then lastly, ideas are only powerful when they're applied. And so we'll also cover some practical steps that are relevant for your guys' personal situation. Okay. So just before we dive in, we want to get an idea of where everyone else is in their investing journey right now. And so we'll just launch a poll right here. And so maybe you're in the beginning stages of your investing journey. Maybe you're using like a mutual fund at a big bank, these kind of places. Or maybe you haven't even started at all, and that's totally okay. Perhaps you're using an S&P 500 index, something a little more advanced. Or maybe even more advanced, you guys are using something like a global index, maybe a robo-advisor, like a VGRO, those kind of places. So we'd love to know where you guys are at. So feel free to stick it in here, and then we'll see where everyone is at.
All right, the votes are rallying in. There's actually a surprisingly pretty good spread, I would say.
Yeah.
That's the responses here.
Looks like it's being dominated by haven't started investing, mutual funds, and S&P kind of some more advanced people along the way.
Yeah, no
There's one person and then none of the above, which is very interesting.
We will close it in 3, 2, 1. Jordan, do you want to go ahead and share the poll results? Thank you very much.
Yeah, it looks like 17% for haven't started investing, 46% in mutual funds, and then S&P at like 19%. Just for the people who are watching the recording, they can see what that is.
Yeah.
And so very interesting. So I will quickly mention people who haven't started investing. I will say that some of this information is definitely going to go over your head a little bit. Okay. But we actually have another class, me and G. So you can maybe message us afterwards. You can watch that class first, and then this one, it'll make a little bit more sense. This class is a little bit more for people who have a little bit of experience, but either way, you guys will get a lot of value. So I'm excited to talk about that. Okay. So this is great. So the reason we like to do this poll, especially for me and G, is that what we find is time after time, almost every person we have met learns to invest in this order. So when they start investing, usually they start with a mutual fund at a big bank, right? But then they tend to change when they learn that mutual funds in Canada have very high fees, and that almost every mutual fund underperforms all the other options. So then you decide to go to an S&P 500 index, which has much lower fees. But then you realize that if something bad happens to the US market, your entire portfolio is going to be toast. And so eventually you switch to a global index, and that dramatically reduces your risks. And finally, you may be wondering, is there something even better that you could be doing with your investments? So that's what we're here to talk about today. So go to the next slide here. And the first thing I'd like to ask you guys is, does anyone know what the average investment return is for the US stock market for the last 100 years or so? So is it like 6%? Is it like 12%? Is it 10%? Jonathan Chin instantly, 8 to 9%. Viru, 8 to 9%. Okay, pretty good. Let's see, anyone else has got any guesses? 11.8%. Oh, interesting, 7%. Samson at 7%. Okay, cool. Gurinder gets the closest answer. So well done, Gurinder. The closest guess there is about 9.7% is the average. Okay, so that's since 1930s. And so what's interesting is if we had invested $100,000 in the US market for 40 years and in the S&P, which returned about 9.7%, you guys would have about $4 million at the end of that period. So that's cool for some people. For some of you guys, that's some review, right? And so what if I told you that during the same time period, there was a mystery investment that returned 14.4% during that time? And so what that would look like is if you had invested that same $100,000, but at 14.4%, what would happen is you would end up with about $22 million. Okay, so that's a difference of $18 million. And the only thing that you did is change your investment just a little bit to a different place. And so some of you guys would be thinking, like this sounds really good. And when I've heard this myself for the first time, I thought, this sounds like very interesting, but show me the data. How does this actually work, right? And so we'll get to the data in just a second. But I want you guys to just really think about that for a second. What would it be like if you guys had an extra $18 million in your bank account today? So for some people, that might be you could work because you want to, not because you have to. You could walk into any restaurant that you want and order whatever you want. You could basically spend more time on your favorite hobbies, and you could be outrageously generous along the way. Those are just some ideas of things you guys could do.
Hi there, and sorry to interrupt you. I've got
Yes,
a
Jordan.
question from Samson, and is that including inflation with the growth of the S&P 500?
Great question. So this is not indexed to inflation. So great question. Yeah. Aishwara has a great question, and our job has a great question. We're actually going to talk about risk in about 15 minutes. So we will go there afterwards. But great question. It's very important. Risk is the biggest part there. Yes, people would buy a yacht. That's great. So we'll keep on going here. So let's go down to this. So back to the data now. When we look at the S&P 500, it's not a bad investment. But I want to ask everyone, does anyone know what the S&P 500 was originally designed for? It was designed to track something. Does anyone know specifically what the S&P 500 was designed to track? And if not, someone is so bold to guess, I will give them a big thumbs up. Let's see. I'll give someone a hint. Oh, pretty good. Okay, Thiru says Fortune 500 companies. Claire says general economic growth. Okay, so if you combine the two, you guys actually have the answer pretty much. So it's basically the S&P 500. It was designed to track the US economy, US stock market specifically. Okay, sorry, I said economy, but it's actually the stock markets, which is specifically 500 of the biggest companies and best companies in the US, right? And so think about that for a second. The S&P 500, it was designed to track the US stock market. It was not designed to make money. And so this interesting situation is what inspired two professors, who are these two guys over here, to create an investment that was designed specifically to make money. And so what they found is after years of research, they published their peer-reviewed data in the Journal of Finance, and they won a Nobel Prize for their work. And this investment is what we just talked about, and its name is called small cap value. And so today, G and I, we're going to be sharing their discovery with you, okay? And we're also going to share how to practically apply this theory to your guys' real life situation. We just want to be really clear that what we share today is not ours, but it's from the highest level of peer-reviewed research. And this is basically information that you can find online, and it's unbiased in that respect. Okay. So there's the tombstone there. I'll leave it to G, who's going to get us started into the fresh new stuff on small cap value.
Awesome. Thank you, Jacob. So let's talk about this mystery investment today then. Let's talk about small cap value. And one of my favorite ways to do so is to take you back to a 5th grade classroom in this analogy. So imagine you're in this 5th grade classroom, and I ask you this question. Do you think some students will perform better than other students? Sure, they do. Well, what if I asked you, why is this the case? What are some characteristics of one student that allows it to do better than another student? And so you might be thinking, well, here are some characteristics. They're harder working, they're goal-oriented, they enjoy reading, and they have supportive friends. Essentially, we can agree that students with these characteristics will probably do better than students without these characteristics. And so this line of thinking can actually be applied to our investments as well. I can ask you, do some stocks do better than other stocks? Sure. Well, then why is that the case? What are some characteristics of one stock that allows it to do better than another stock? And so today we want to talk about 2 characteristics. Number 1, small versus large stocks. And then number 2, value versus growth stocks. And so we're going to explain these characteristics in the next slide. But for now, all you really need to know are that there are 2 characteristics that tend to allow certain stocks to do better than other stocks. So now let's talk about these characteristics. Value versus growth. So if you haven't heard this before, let me explain. When it comes to a growth stock, it's essentially a stock with a very high price compared to the actual value of the company. I can use an example. Imagine there's Tesla, the car company, which earns $20 million per year. And then there's Toyota, which earns $18 billion a year. So it's pretty clear to see here that Toyota is actually the more valuable company in the sense that it's earning more money. Yet Tesla actually has a higher stock price. So even though Tesla's value is lower, its price is higher. That's what we deem to be a growth stock. High price compared to the actual value be down here. Value stock, on the other hand, is the complete opposite. It has a low stock price compared to the actual value of the company. And the best way for me to explain this is like a t-shirt that's on sale. So imagine we see a really nice t-shirt in the mall. We go to Foot Locker, for example, and we see a t-shirt, it's a great look, great feel, a great fit, but it's worth like 50 bucks. Now, I don't know about you, but to me, a t-shirt that's 50 bucks, that's pretty expensive. So I'm like, oh, it's kind of expensive. I decide to come back a few months later and I see the same shirt again. Same great look, great fit, great shirt, great stock, but the price has gone down to 25 bucks. So what we see here is the price is lower, but it's the same great stock that we see. That is a value stock. Low price compared to the actual value of the company. Now let's get into the fun stuff. Let's look at the data. How often do small stocks tend to beat large stocks? If we look at every 10-year period over the last 60 years, we see that small beats large 72% of the time. Okay, not bad. What about every 20-year period? 82% of the time. Now we're talking. What about value versus growth? 86% of the time for 10-year periods. And for 20-year periods, value has beat growth every single time, 100% of the time. I don't know about you guys, but that's still a crazy stat to me, even though I've seen this so many times. And so there are the stats up there. I'll let you guys screenshot it if needed, but let's carry on for now.
And then before you carry on, G,
Yes.
I have a question from Aiden. When you say price, do you mean price of the shares or total market cap?
What we're using as a price to book measure in terms of value, if that, I know who Aiden is, and I think he understands what that means.
Yeah, also I just messaged it just in chat there too. So
Yes.
that would be price measured by market cap.
Yeah, market cap, that's right.
I can tell maybe Aiden has a finance background. So great question. Yeah. And then
Awesome,
Theodore
Aiden.
also asks, how do value stocks differ from penny stocks? I'm not sure if you want to answer that now, G, or maybe a little bit later. What do you think?
We can answer that at the very end. It's going to be a little bit lengthier. Yeah.
Okay, yeah, that sounds good.
Awesome. Okay, great. Let's carry on for now. So really what we talked about is if you just imagine like a car, we talked about how the car engine works, but you probably don't care about how a V8 turbo engine works. You just want to know, how does this help me? How does this help improve my investments? So that's what we're going to talk about. Let's actually look and see, how do these indices perform? So a lot of people invest in the S&P 500. Not a bad choice. The 500 largest companies in the States. If you had done so, you would have gotten an average of 9.7% return. Great. But what if we adjust your portfolio by turning this knob here and we incorporate more value stocks rather than growth? So the S&P 500 often has very high priced companies. So instead we incorporate value stocks. Then this is the result, 11.2%. And then I can say we can adjust another knob here and we incorporate small companies instead of large. Again, S&P 500 are the 500 largest companies. As a result of this, there's a 12.7 annualized return. And then we can actually take these two characteristics together, adjust both of them, incorporate them into one index, small cap value, and there's that 14.4% magic number that we saw in the beginning. There's the difference. If you're not blown away yet, this next slide is my absolute favorite slide. So let's take a look. Okay, so there's a lot of numbers going on the screen here, but just follow along with my mouse, okay? So we have different asset classes, different investments up top. Large cap value, large cap blend, large cap growth, small cap value. There's so many different types. I just want you to focus on these two. So large cap blend is something like the S&P 500. The NASDAQ 100 would be something like large cap growth. I want to focus on large cap growth versus small cap value. Reason why is because a lot of people invest in large cap growth, and what we're talking about today is small cap value. So the question that's being asked here is, what are the odds that what I decided to invest in was the best choice that I could have made? One more time. What are the odds that what I decided to invest in was the best choice I could have made, right? We see here, percentage of time that your investment performed the best. It was the best choice. So let's take a look and see. For a 1 year period, if you had invested in large cap growth, it would have been the best performing asset 11% of the time. If you instead had invested in small cap value, about a quarter of the time. Now you might be thinking, well, I'm a long-term investor, so I actually don't care too much about the short-term returns. Show me the longer term. Sure, let's jump to 10 years. For a 10-year return for large cap growth, it drops to 6%. Small cap value, it's about a coin toss, about a 1 in 2 chance, about 50% of the time. And you might be thinking, well, I'm in my mid-20s now, and I hope to retire in 20, 30, 40 years. Sure, then let's look at the 20, 30, 40-year returns. Large cap growth, zeros across the board. Never was it the best choice you could have made, but small cap value, 72, 82, and 94.3% of the time, it was the best performing asset. It was the best choice that you could have made. So I'll let you guys screenshot this, ask any questions if you have any, but I don't know about you guys, when it comes to my important money, I want to invest my money in a way where the money does what I hope for it to do. And so I'd want to invest my hard-earned money on probabilities like this. I'll carry on here. So very often we have people come to us and tell us about how they invest. And this is oftentimes what we see. Most people, they often invest in something like the S&P 500, NASDAQ, sort of an index fund, or they'll pick individual large tech stocks because they performed very, very well in the past couple of years. So something like Amazon, Tesla, Netflix, Google, you name it. But here's the thing. When an investor invests in a particular way, they're making a statement. They're making a statement that what they decided to invest in will be the best choice that they could have made. And so what statement are the S&P 500 investors making? They're stating that large companies will outperform small companies. Again, S&P 500 are the largest companies in the States. So they believe that large will outperform small. And they also are stating that growth companies will outperform value. S&P 500 often has very high priced companies inside of this index, such as Amazon, Tesla, Google, Netflix. And so the statement that S&P investors are making are that large and growth stocks will outperform. But what does the actual literature suggest? The opposite. 94% of the time we just saw, investors would have done better with small and value stocks. I'll let Jacob take it away, talking about the risks of small cap value.
That's great. Thanks, G. Someone has just asked anonymously if we would mind announcing before we switch each slide. I know we're going pretty fast. So unfortunately, we won't announce as we go through each slide, but we'll definitely be having a recording so you guys can watch it afterwards. Yeah, we just want to make sure that we're respectful of everyone's time. And they also asked if we can get a copy of the slides at the end of the presentation. Even better, you'll get an explanation of a video, and then all the citations, as you guys can see, even on this slide, is in the bottom right. So you guys will get all of that. One more question here is, Kellen, will you be able to get references for this data? Never mind. Yes, he's got it. Cool. So yeah, every single slide we have in the bottom right, you guys can see some of it is cited directly from Journal of Finance. So you can go there and see the breakdown if you want to. And then yes, the other data is based off other places that are also been reviewed by us. Okay. So I'm gonna switch back to this setting here so that I can see everyone's chat when I talk. And we're going to talk about risk right now, which is something as Aishwarya and I think our job, we're asking about. Investing is really awesome, but one of the biggest things we need to know is how to manage risk. And so we'll talk about managing the risk for small cap value in this section. So the single biggest risk for small cap value is probably not a surprise. It's the increased volatility. So for example, if you guys had invested for the last 50 years, the worst drop for the S&P was 51% in comparison to small cap value, which was 61%. So when you guys are young, and let's just say your investment portfolio is only like $10,000, losing 61% is not so bad. But once your portfolio starts to grow, maybe it's worth $1 million. If you lose $600,000 in a single year, you're going to be in a lot more stress than if you had just $10,000, right? So let's go to the next slide here. And so G showed you guys his favorite slide. And so this is my favorite slide. Okay, so I'm going to slow it down here. And so this table here, what it does is it summarizes every 40-year return for both the S&P and small cap value. And so if we took the investment return between 1928 and 1968, that's one 40-year period, right? And the next one is 1929, 1969, that's another 40-year period. And we'll do that all the way up to 2014. Okay? And so the first thing you'll notice is that when we load this table is, what happens is small cap value, you guys will notice, has outperformed the S&P 500 in every single category, okay? And what I also want you guys to notice is even with the steep drops of a small cap value that we discussed on the previous slide, the worst 40-year period in history still returned 11.8%, okay? I just want you guys to think about that for a second, okay? The worst 40-year period for small cap value still outperformed the average return for the S&P 500. Okay, so that's pretty insane. So that's a lot of numbers, and I know not everyone is a numbers person. So we just want to summarize this slide into two key points. Okay, so the first one here is, due to the volatility of small cap value is only for long-term investors. For this reason, it would make more sense to invest for a minimum of 5 years, but ideally for at least 10 years. And the reason why is because if our portfolio can drop by 60% or more, right? And if that happens, we need to remain invested for a few more years so that our portfolio can recover. The second thing is that you don't need to invest your entire portfolio into small cap value for it to be effective. Even 20% could make a very big difference. And so I'll let G explain this with a quick analogy.
Yeah, thank you, Jacob. So really, when it comes to, I love analogies. I don't know how many Korean people there are in the audience or how many people have gone to eat at a Korean restaurant, but I'm Korean. And when we eat, we have a bowl of rice with a number of different side dishes. And so this is almost analogous to your investment portfolio. You can have a big chunk of your investments be this boring bowl of rice where it does what you expect it to do. And you can spice it up with different types of investments. And so the point here is the small cap value fund, it doesn't have to be the entirety of your entire meal. It can be this spicy new side dish that you incorporate. And like Jacob mentioned, a 20% addition to your portfolio could make a significant difference. It can make your meal taste a lot better. And so whatever meal you're used to eating, you can simply incorporate small cap value as a side dish is the message that we're trying to say.
That's great. Thanks, G. I'm just reading the questions here. So Aishwara has another great question. They ask, if small cap value is good with long-term returns, is it advisable to use TFSA or RRSP? I want to tackle that one at the end of the presentation, I think. Okay with you, G?
Sure. Yeah. Jordan, just make sure you take a note of it, please.
Cool.
Yep.
And then Samson. Yep.
Oh, sorry. I just had one more thing here.
Yes,
Scott asked if the data reference was back in 2013. Do you guys have any data from 2013 to the present?
I do. Yes. Let's do that during Q&A as well.
Yeah.
Is that okay?
Because we'd have to shift the screens and whatnot.
Sure.
Yeah. Okay. Can you say that for me, Jordan? All those different questions. Yeah, you got it. Thanks, man. Great. And then Samson here might be covered later, but is the US small cap value a specific index like RSV? Samson, is your question like, how do you actually do this in real life? Is that kind of like where you're kind of going towards?
Yeah, exactly. I think some other people had similar questions, like how do we identify what are the small caps exactly, and what portfolio is this? Like S&P 500, obviously very specific, and then yeah, but thought it might be covered later.
Gotcha.
We thought you guys would ask that, and so that's actually, I think, the very next topic. It's actually the very next slide I see on my screen. So
is it? Oh, this year. Yeah. Samson, maybe you should teach our class. You've got exactly the questioning. Yeah, good. So we'll talk about a second, and then Tulin, I haven't seen the question here, but how can you tell what is considered small cap value, or how can you decide which ones are best to invest in? Okay, yeah. So we'll tackle this in the next question as well. Yeah, we'll tackle this in the next section. I'm just thinking, yeah, how about we'll do it first, and then Tulin, if you're confused at all, we'll definitely be able to discuss that more. Thanks, I got a little thumbs up. Perfect. Okay, so let's keep on going here. Make sure I didn't miss anyone. Peter's got some good jokes here.
There's a funny comment. Panchans are the best. You got this down. Appreciate it. Thank you. Panchans are side dishes in Korean, so very cultural.
He knows. Man of culture.
Very nice.
Okay, so let's keep on going here. Yeah, so let's talk about how to actually do this in real life. So there's two ways that you guys can invest in small cap value in real life. And the first way is through, if you're a DIY investor, do-it-yourself investor. Okay. And so one example here is we have a model portfolio that is diversified, created by a guy named Paul Merriman. And this portfolio includes 5,000 companies from around the world. There's also a citation in the bottom right there, if you guys want to know a little bit about his rationale and why he picked those different tickers that are there. So I'm going to pause here for a quick second so that you guys can take a quick notes or take a quick screenshot, and then we'll keep on going in about 2 seconds here. Okay, and so if you guys feel like small cap value is a little bit too aggressive, like it's too much, like all at once, just like G mentioned, you guys can want some side dishes. Here's another portfolio created by a guy named Ben Felix. Okay, and what this investment portfolio does is it's less aggressive, and so as you can see, about only 16% of this portfolio is specifically small cap value. And so in this scenario, with this kind of portfolio, you would still own about 12,000 companies from all around the world, like you would in a normal index fund. However, you would own less of the large growth companies and more of the small value companies, which historically have been more likely to outperform. Okay. I'm gonna pause here again. If you guys want to take a quick screenshot or write these down, and you guys can see the little citation down there. Got also a message in chat. Let me just see if this is relevant right now. Graham has a great question. Yes. Maybe we'll tackle that in the Q&A as well. Great question, man. Yes. I can tell he knows what he's talking about. So Jordan, take a note of Graham's question, and we'll just keep on going just in the interest of time for everyone. Okay, so the last thing I mentioned about these portfolios is that these model portfolios are examples for educational purposes only, and they're not recommendations. If you guys have questions about this, which you guys obviously do, we'll tackle them during the Q&A. You can also ask us offline, and that'll be okay too. So I'll let G talk about what it's like to use small cap value through an advisor now.
Excellent. Thank you, Jacob. So yeah, the question often comes up, you're teaching us how to do this for free on our own. Where's the value add in terms of working with an advisor? Where does it fit in? And so the other way that you could go about doing this is to work with an advisor. Please note that banks do not actually offer small cap value. So you would have to find an advisor who offers small cap value funds. One of the most popular funds is called Dimensional Fund Advisors, or DFA for short. No, we don't actually work for this company. Again, both Jacob and I, we don't work for this company. However, just to be very transparent with you all, we actually both invest in DFA funds ourselves. They happen to be some of the world leaders in this space. And the Nobel Prize winning researcher that we mentioned in the beginning, Eugene Fama, he himself is actually on the board of directors for this fund. And so while they are great, unfortunately, they can only be accessed by certain advisors that are approved by the company. And furthermore, you have to have often a certain minimum amount of investments to invest with certain types of advisors. Now, with that being said, let's take a look at a real life example of a young professional and how their potential portfolio could look. And so we can see in this chart here, we have the goal, timeline, and investment tool. And so for this person, we have different goals here. So we have someone who needs an emergency fund right now. They need a car in the short term, maybe a year from now, a house, let's say 5 to 7 years, so medium term, and then retirement 20 plus years away. And so the reason why we're showing you this, by the way, is because very often when we teach people about small cap value, they get really excited and then they invest all their money to small cap value. But they often don't realize that the way you invest for your short-term goals should look very different from the way you invest for your long-term goals. And so let's take a look at these for an example. For your emergency fund, if you had put all your money into small cap value, it drops 60%, but then your car breaks down, then you actually won't have the money when you need it for the car, which means you ultimately wouldn't be able to use your car. This is why for something like an emergency fund or any short-term goal, let's say within the next 5 years or so, it should be invested quite conservatively. And so something like a high interest savings account could make sense. So there's high interest savings accounts out there that are offering 4% plus, or a high interest savings account ETF or HISA ETF to offer nearly about 5%. And so other examples could include something like a GIC, for example. But the reason why we would want to do this is because we want the money to be there when we need it. Now, for the next item, we have a house purchase goal. This is a flexible medium-term goal. Now, it's not long enough where we can invest as aggressively as possible, but it's also not so short where we shouldn't have some exposure to stocks, as stocks tend to have a greater expected return over the long period of time. And so, believe it or not, you can actually have a portfolio consisting of stocks and bonds. And so what this means is the stocks allow you to have this greater expected return. However, there is greater risk. And the bonds, the purpose of it is to smooth out the ride as there's less risk. However, there's also a less expected return. So you can have a portfolio, something like a 60-40 split as an example. And as for retirement, because this is 20 years away, we would have the ability to wait for investments to rebound when they go down. So markets, they need to breathe. They go up, they go down. But because we have the time to wait for this to come back up, that's with this reason, we can actually give it more exposure to stocks, more specifically, small and value stocks, for example, as they tend to have a greater expected return. And so again, the point of this slide is to show you that not all your money should be going to small and value stocks, but this here can simply be an added side dish to your portfolio. And so as an example, the high interest savings account may be the boring rice bowl that you have in the middle, and it gives you the slow, boring returns. It's the base of your portfolio, but we can spice things up by adding in a stock and bond portfolio. And then we can introduce this small cap value side dish, this panchan, as the previous person had mentioned as well. So I'll give it a pause here just in case there are any questions or if anybody wanted to screenshot this.
Yeah, we got a question here, G, from Caitlin, who asks, are HISAs, high interest savings accounts, the same as high yield savings accounts?
So I don't often hear the term high yield savings accounts, at least in Canada. My guess is if we're talking about a bank account, then it would be the same thing. It's essentially a, you know how you have your checking account and your savings account. The savings account offers a little bit more interest. That's the idea of a high interest savings account. And so if the high yield savings account acts in the same way, then yes, it is the same thing.
Yeah, great question, Caitlin, because yeah, some people use the term interchangeably, but the key thing there is they have a higher interest rate than average for temporary savings. Yeah.
Yes.
Does that answer your question, Caitlin? You can feel free to unmute, or you can just message it.
Oh, okay.
Gotcha.
Perfect.
Oh, American here.
Yeah.
Okay, you are
I was
most
guessing that.
welcome.
Yeah, I was thinking. Yeah, it must have been not a cultural thing, just a different term.
Terminology. Yeah. Cool. Hope you feel welcome, Caitlin.
Yeah. Welcome. All right, let's keep going on here. And so when it comes to working with an advisor, like I mentioned before, where do we fit in? And so there are actually multiple studies that show those who invest with an advisor do about 3% better than those without an advisor. And so there's 3 citations on the bottom right here, just to back that up. And so to illustrate what 3% really looks like in terms of a value add, let's say you had invested $100,000 and you got 10% return, then over 40 years, you would have a $4.5 million amount. And then instead, if you had invested 100,000 for the same time period with 13% return, you would have $13 million. And so that is $8.75 million. That is the statistical value of an advisor. But you might be thinking, well, where does the 3% actually come from in terms of the value add? And a large portion of it is behavior management. And so if someone had actually invested in the S&P 500 and that returned a 10% return, the average investor often would not get the same return. And this is because when things are going well, it's not a problem. But when things go south, people tend to have a tough time doing what they know they should do. And so very often what we see is people know what they're supposed to do, but are they able to do it when the time comes around? The studies have shown people actually can't seem to hold their investments themselves, and they need someone to hold it for them. And one of my favorite analogies to introduce to this as well is a toilet. So imagine your toilet breaks down at home. You technically could go on Google and figure out how to fix a toilet and do all this research on your own. But now you're spending time, effort, energy, and stress trying to fix your toilet, and you're spending a lot of time on Google researching toilets. Is that really what you want to do with your time, right? Furthermore, you realize that there's multiple components to a toilet. You just had the handle broken, but if you mess up the first time, then maybe someone actually has to come in and fix not just the handle, but multiple parts of the toilet as well. And you only research the handle part. And so this is analogous to your investment portfolio and your financial plan as a whole, right? Maybe it makes sense for the person to just focus on what they're good at, which is working and making the money. And then your hard-earned money that needs to be managed with all the moving parts, such as tax, insurance, estate planning. What the heck does that mean? If you haven't heard of it, well, that's essentially with the value of an advisor. They come in and just take this plate off of yours completely. And you'll just hear the words, you're good. You're on track for your goals. We got you. That's sort of the idea in terms of why it is that you want to work with an advisor. Okay, so that's a lot of information and we're wrapping it up close to the end here, but hopefully you leveled up from whichever stage you were at, whether you were at the mutual fund stage, you're investing in a passive S&P 500 index, you were at a global index stage, but now you know the next step up, which could be small cap value. And so hopefully you leveled up today. Now, if you want to level up again, the next level past that, believe it or not, there's more levels to this, is alternative funds. And so this is just a quick plug for the upcoming workshops that Jacob and I hope to do probably around the springtime. So keep your eyes and ears peeled for that. And we'll be doing another workshop shortly soon. I'll let Jacob take it away with the summary of today's presentation.
Cool, thanks, G. So yeah, I don't know about you guys, but especially if you're a little bit newer, I feel like that was just like a big fire hose of information. So for you guys who are there and also maybe some of the experienced guys, hopefully this one-page summary will make everything pretty digestible for you guys. So the first thing that we learned, right, is that the S&P 500, it was designed to track the US stock market. It was not designed to make money. And that is what led two professors to create an investment that was designed specifically to make money. And their discovery, which ultimately won a Nobel Prize, is called small cap value. The second thing we learned is that the average 40-year return for small cap value is 14.4% compared to the S&P at 9.7%. Over 40 years, a $100,000 investment would have generated an additional $18 million. That is how powerful a single idea can be. And as G mentioned, when it comes to our important money, we want to make sure that our money is invested in this kind of process with probabilities based on this. The last thing I want to mention on this bullet here is that between 1928 and 2014, the worst 40-year period for small cap value still outperformed the average return for the S&P. And in total, small cap value outperformed every other index 94% of the time. And actually, I just realized I said every other index, or every other investable index investment that is globally diversified 94% of the time. Thirdly, the main risk of small cap value is increased volatility. For example, between 2007 and 2009, small cap value dropped by 61% compared to the S&P at 51%. For this reason, investors must have a long-term perspective on their investing and set proper volatility expectations. Also, as we mentioned, you don't need to invest your entire portfolio in small cap value. Even 20% can make a very big difference. And the last thing that we mentioned is if you want to get started, DIY investors can use the model portfolios created by Ben Felix and Paul Merriman. Just make sure you get your plan double-checked by a professional before you jump in all the way. And we also mentioned that if possible, G and I always recommend using an advisor. And the reason why is because there are multiple studies that have found that investors with advisors have outperformed DIY investors by about 3% per year. And we've also seen that with our own clients. And 3% might not sound like much at first, but if you have a $100,000 portfolio and you invest and there's a difference of 3%, that could easily be a $9 million mistake. So we'll pause here so you guys can take a quick screenshot, and then I'll let G wrap us up for today.
Sounds good. So we'll allow 10 seconds just to take a screenshot, ask any questions if needed.
That's great. Yeah, I'm going to compile some of the questions that have come in chat too.
Yeah, I actually had some of the questions down here.
Oh, thanks, Jordan.
Yeah, so Scott previously asked about the data from 2013 to the present day. Wondering if you guys can just pop it in for them to look at.
Yes.
Or have a look at that.
Yeah.
And we have another question from Ashwar. I don't know if this was talked about. She asked if the SCV is good with long-term returns, is it advisable to use a TFSA or an RRSP fund?
Oh yes. So the very next slide is the Q&A slide. So we'll address that in just 2 seconds.
Okay, got it.
Yeah. Thanks, Jordan. Perfect. Yeah.
Yeah.
Thanks for recording those because we'll definitely
You're doing
we
great.
get lost in the chat a little bit.
Jordan's first date. So
Thank you.
killing it. Okay, let's bring it back here just because it looks like the questions are piling up. So just before we dive into the Q&A, first of all, thank you all for making it to the end. We really appreciate just having spent this time with you. Hopefully you enjoyed it as much as Jacob and I did and learned a thing or two. Really, when it comes to this slide here, you can first of all follow us on any of our socials. We'd love to connect. One of the most exciting things for Jacob and I is just seeing the next day all the different people that just message us afterwards and whatnot. And we find that, yeah, it's very easy to make friends this way. So feel free to connect with us. You'll see a QR code here as well. And Jordan will go ahead and throw a survey link into the chat box below. If you could just take 2 minutes of your time to just give us some feedback, what was helpful, what could be improved upon, that would mean a ton to Jacob and I. We love doing these presentations and we would love to just see how we can continue to improve as we just do them moving on into the future. And the last thing is, if you do complete a survey and you put your email in, you'll be entered to win a $30 gift card of your choice. And so those who are watching the recording as well, the winner will be announced a week from now. So if you're watching the recording, you can actually scan the QR code and complete the survey, and you will also be entered in as well. And so we'll reveal the winner in a week's time. But we'll give it 2 minutes for you all to finish the survey, and then we'll jump right into Q&A.
That's great. Thanks, G. So G's going to pull out his guitar and he's going
Oh,
to...
yeah.
Okay. If you're cool with that, are you good with that? If you can't, that'd be cool. Yeah.
Okay, sure.
Okay, cool.
Okay.
Yeah, so you guys can fill in the survey now, and then if you guys want to put some questions in the chat, well, if you get done early, then we can do that as well. Okay.
All right. I don't know if it's in tune.
Oh, okay. That'll be fun.
Well, we'll cut it out from the recording if it's not great.
Yeah. Okay. Sounds good.
Oh no, I'm not using my computer. I'm using a separate computer camera, so
it's good, man. It's good.
Okay, I'll try.
Cool. So I'll leave you to it, and then you guys have made some questions privately as well and in the chat. So keep on sending those. Those are great, guys. Thanks.
Oh, okay. Hold up. I think that'll do for now. I can't seem to remember how to play my songs.
Oh, sorry, man. I put you on the spot a little bit. Cool.
Alrighty.
So do you want to just jump in then, G?
Sure. Let's go right into the Q&A. So,
Okay, there's Thiru's question from the very beginning, so we'll get to that first.
ready.
Okay, so Thiru's with us. I can see already, man. So it was something about penny stocks. Let me just see here. So how do value stocks differ from penny stocks? And just so I understand your question, Thiru, are you just thinking like what is it? What is an example of a value stock versus a penny stock? Or just want to make sure I understand your question there.
Everyone I've spoken to has this notion that penny stocks are like super high risk, super high reward, and there's a lot of money you can lose from it.
Right.
And value stocks have a great set of investments, and so do penny stocks. So where does it stand in terms of the stock market or in terms of investing from a financial standpoint of the risk reward ratio for pennies and how it varies from a value stock in terms of investments?
Great question. Cool. So the first thing that I'll mention, and maybe G, you want to go to the summary slide so that people can just sit on that as they ask questions. Yeah. Or we can even stop the share. People can see us. It's up to you. So first thing here is when you look at risk for a penny stock versus small cap value, when you're using a small cap value index, you're using a group of stocks, right? So as you can see, there was an example with 5,000 different companies, and there's also an example with 12,000 companies. So the first big difference is that your risk is dramatically reduced because you're diversified over a lot of different places, right? If you get an index of penny stocks, a group of stocks that are just penny stocks, it diversifies you, but then now you're all this just full of high risk stuff, right? So that's the first part. Second part is when you look at penny stocks, usually the value of the company, like as a whole, is really small, something like $20 million to $100 million, and that's considered small in case anyone needs to know. Okay. And so that's one piece that's really different. So when we pick small cap value stocks, actually those companies tend to be around the $2 billion, $3 billion range, right? So that's what small is, just so you guys know. So $1 to $3 billion. You guys think, okay, that doesn't seem small to me, but relatively that is still small, right? Compared to like the Amazon and stuff that are like $1 trillion company, right? So that's the big difference, and also how the risk differs. Yeah. Did that answer your question, Thiru? Was that a little bit unclear? That's good. Okay, perfect.
Yeah, all good. Thanks, Jacob.
Cool. And then G, feel free to add anything as well. And I'm just going to go to the next question here. Okay, let's see. What was the next question after Thiru's? Do you have it, man? I'm just scrolling all the way back here.
I'm scrolling as well right now, trying to find it. Jordan, do you happen to have the order of questions?
Yeah. Okay, yeah, this is the one before I interrupted you guys.
Okay.
Q&A. Yeah, it's from Ashwarya. She asked if the CSV is good with long-term returns, is it advisable to use a TFSA or an RRSP fund?
Okay, I can answer that. So when it comes to the decision around the TFSA versus RSP, in this case, because they're globally diversified, we expect the money to do what we hope for it to do, which is to have a certain amount of return with some volatility. So with that being said, we're not taking excessive risk where we're thinking the money is just going to disappear one day, right? So with that, we can actually go ahead and use both of them. Now, the decision between using a TFSA versus RSP isn't necessarily on the investment itself, but rather your situation. So if you're someone who has a very low income at the moment, then maybe it doesn't make sense to use the RSP just yet and use the TFSA first. The reason why is because when you make a contribution to your RSP, you get a tax deduction based on your marginal tax rate, based on how much income you're earning. But if your marginal tax rate is not very high, then you don't get to capitalize up on as much of the tax savings versus if you had waited a few years and then you contributed to your RSP when your income is much higher. So that's an example. The other thing to consider is as well as liquidity need, meaning when do you need your money by? And so if you put in money to your RSP, but you need to purchase a car in 6 months, well, you could take this money out of your RSP, but it's going to be considered taxable like income, and you actually lose that RSP room completely. Versus TFSAs, you can put that money in, take it out tax-free, and the next year you can put the money back into your TFSA. So those are just a few examples of things to consider, but you'd want to look at your situation more so than the actual type of investment that you're investing in. Hopefully that makes sense.
Yeah, that's right. And Aishwar, does that answer your question, or was there anything you want to clarify there? Because I'm not sure if maybe your question was kind of more towards like foreign withholding tax or something like that. Just want to make sure that we answered your question.
Good point.
Yeah, you can. Jordan, let me know if Aishwar messages at the very bottom, or else I'm going to lose my.
Oh, I see it here. So TFSA versus RSP in perspective of risk profile is it going to be worth risking my retirement with money with small cap value? So I guess, yeah, to answer that, when we invest for the longer term, we want to make sure that our money does what we expect it to do. And one of the best ways for us to design a portfolio in this way is to make sure it's properly diversified, right? So even if the US is doing really, really badly for a handful of years, it's okay. I'll actually give this example in terms of diversification. Imagine you are looking to fish at the lake and you want to catch some fish. If you were to fish on your own, you might be thinking, well, if there's no fish here, I might not eat tonight. So what if I could call 10 of my friends to fish at different parts of the lake? Now there's a better chance I'll be eating that night. But what if I actually am able to call 100 of my friends and I throw them over by the river or into the ocean? Or what if I could have 1,000 of my friends and some of them even go to the riskier parts of the ocean where there's big tuna, but it might be a little bit more dangerous. There's a lot better chance that I'll be eating that night. And so the same way, when it comes to our investments, we can globally diversify. A lot of people tend to only diversify in the States with the different sectors and types of companies, but we can actually go ahead and invest all around the world because there's no way for us to know whether the US will continue to outperform every other country. And so by having this proper diversification, there's a greater expected, expectation in terms of our money doing what we expect it to do, which is give us a certain amount of return over a certain amount of time frame. So hopefully that answers the question. Okay, perfect.
Okay, did Aishwarya reply there, G?
Yes, she said that.
Yeah, okay, cool. Okay, perfect. Jonathan Chin asks, are these actively managed funds? So were you referring to the model portfolios there, Jonathan, or was that something else? Just let me know in chat. Or
like the calculations, or like, is that like actively like the top whatever companies they're holding, a small caps is like keeps changing every year, or is it like the same ones from the beginning to the end? Because I know S&P 500 is like the top 500, so that one's actively changing, but I don't know for your comparison what it is.
Right, great question. So is your question kind of like, how do they decide what is held in that index? Is it kind of what you're?
Yeah, so for that calculation, yeah, so like the top
Yeah.
or whatever, I don't know.
Gotcha. So the answer to that is they are technically actively managed in the sense that the holdings change, but it's rules based. And so what we talked about before is like, what metric do you use to make sure that it's actually a value company? What metric do you use to make sure it's actually a small company, right? And so the long story short, like to answer your question, is that if you take those, let me think about how I'm going to answer this without getting flagged by compliance. If you take those indexes that we mentioned, they tend to move from like small to large companies as they grow, right? They tend to move from value to growth as their price goes up, right? And so once they leave a certain threshold, then they become a growth company, or they become a medium or large company, right? And so that's when it triggers the decision to take that company out of the index. Does that answer your question, Jordan? I mean, Jonathan?
Somewhat, I
Okay.
guess.
I can try as well. So it's almost like an actively managed mutual fund there's a portfolio manager trying to pick and choose the right type of stock at the right time. It's not actively managed in that sense. It's actively managed in the sense that, let's say there's an ice cube tray. We're going to tilt the ice cube tray so there's more water on this side. So we're tilting it towards the small and value stuff. The small and value stuff may change, right? Because, Coca-Cola, for example, started out as a small company, now it's huge. And so these will change, but the concept, the rule that they use to actively manage it's this mechanism. And so they'll look and see, based on certain formulas, what fits within our categories, and we'll pick those. It's not based on like, because dog food is doing this in the economy right now, this is going to do really well. So it's not, Does that kind of make sense?
Yeah, that makes more sense.
Okay, cool. Hopefully that's helpful.
Thanks, G, for it. Samson asked earlier about small cap value. Is it a specific index? Did we answer your question, Samson, or did we kind of skirt around it or something?
Yeah, it was already answered.
It's good. Okay, perfect, cool. So next, Tulene asks, how can you tell what is considered small cap value? How do you decide which are the ones to invest in? So the model portfolios that we gave examples of by Paul Merriman and Ben Felix, they have those examples on there, and they explain why they chose those ones, how to make sure they're actually small, actually value. So that's a good place to start. We could go more in depth on it, but I feel like that's probably as much as you would need to know. Does that make sense, Tulene? Does that kind of answer your question, at least for all you need to know for now?
Yeah, thank you.
Yeah, okay, that's perfect. Thanks so much. Great question, by the way. So let me go down here. The next one. Let's see here. Samson asks, when you referred to needing private advisors for small cap funds, is this specifically for managed funds? Can investors still directly invest in the ETFs that make up the funds? Yeah. So hopefully was that answered as well, Samson, during the class there?
No, it wasn't touched on. But just want to double check.
Yeah. So if you want to share your screen, Angie.
Yeah, I'll go back to the answer slide.
Yeah. So there's some. So the tickers that we put up there. I'll let G pull it up. Yeah. Great question. Yeah.
There we go.
So those are some tickers there. And I can't see you right now, Samson. So there you go. So these are available to anybody. And what's really interesting is these only became available in 2019, I believe. Yeah. So it's very recent that these became available to the public. You used to have to go through an advisor to access this. Yeah.
Oh, that's really good to know. Thank you. And then basically the managed funds are just like how the portfolio makeup looks and then being able to like balance it in real time. Like that's what the advisors help with, right? Just managing.
Yeah, that's one of the main parts. That's right. Yeah, that's right. Rebalance. Yeah. Okay, great question, Samson.
I actually have a question here from Graham.
Yes.
Ticker AVEM doesn't mention the small cap value in its fund. Is that a fund really small cap value and tilted?
Great question. If you unshare, Jordan, sorry, G, and I'll share here. So if anyone's wondering what Graham's talking about, this is one of the investments that Graham's asking about. So I can't actually talk about the specifics because of compliance reasons, but I will point out two things that are worth mentioning for you, Graham. So the first one here is you can see like one of the line items here they say is that they're overweighting securities trading at lower valuations. And so that is them saying that we're trying to target that value section, right? And then you also might notice here, the guy who's managing this fund is this guy named Eduardo Repetto. And this guy is like one of the like legends of the industry who's really well known for working with like the guy who won the Nobel Prize for this kind of stuff. And so even though it's not explicitly like said, like we are just targeting specifically, the certain like small and value, it is something that they are, they've been preaching about for a very, very long time. Does that answer your question, Graham?
Yeah, perfect. Thanks, Jacob.
Yeah. Okay. Sounds good. Great question, man. That's like you should do my job. That's how good that question is. Cool. So let's keep on going here to the next question here. Okay, and we are over time here, but there's only a few more left, so we'll just keep on going. I got a private question from somebody. So someone asks, as a new investor, would it be smart to still start with mutual funds? Okay. And this one I kind of need some clarification on. So if this person can, if they're comfortable, messaging back or even sharing, we talked about like the progression of an investor. So someone who starts with like mutual funds, then maybe they move on to like a robo-advisor or an S&P 500 index later on. And that might be all gibberish right now. But I would say a really great place to start is actually mutual funds. It's not the most efficient place in the world, but you get to someone to hold your hand. Because with a mutual fund, usually you have an advisor with you, and they can show you, how to like what the markets kind of move like, someone to make sure that you're doing the right stuff and those kind of things. So I would say for a new investor, I would say, a mutual fund is probably a decent place to start.
Yeah, I will throw in as well. I totally agree with that. If you do have enough for the minimum for certain private wealth managers, though, you'll just get better value there. They have access to a bigger, wide variety in terms of investment products. So for example, what that means is if you were to go to just TD Bank, then they would only be able to give you TD Bank mutual funds. Versus if you go to a private wealth manager, they can access, Vanguard, Avantis, DFA, and so on. And so maybe in that case, it could make more sense just because they're able to really personalize their situation. And there's no restrictions there, essentially. So hopefully that makes sense. It just depends on your situation, but it doesn't hurt to do some research and interviews with different types of people.
Yeah, great question to this person who said, okay, thank you, makes sense. I also will mention that like investing is just one section of you guys' financial plan, right? Investing is like, it's an important piece, but there's other parts of personal finance too, like your insurance, like your estate planning, like your taxes, like tax optimization, pardon me, and your tax shelters. Like there's a lot more going on there. So if you have an advisor who can double check those other things too, that would be like, I think very beneficial, especially if you're just starting out early on. Okay, next question here. Yep, go ahead.
I have an honest question here. How would someone be able to find an advisor or work with either one of you, G or Jacob?
So this is gonna be tricky because it kind of depends where they are located. I guess that's the first part. Let me think about how to answer this one, G, unless you want to go first.
I'll need a second as well. I mean, when it comes to working with us, you can just shoot us an email, message us on any platform. And the end of the survey also indicates whether or not you'd like to have a second opinion or have any, like a Q&A session with us. So we're happy to just talk with anyone and just answer questions. But in terms of working together, yeah, it really would depend on a few things. And so always open to conversation. In terms of finding an advisor though, yeah, Jacob, I'll let you answer that. But how would someone go ahead and find an advisor? What do you think?
Yeah, I would say if you're just getting started, like using like a robo-advisor or like the mutual funds at the bank is a really good place. And then later on, if you can upgrade to one of those, like especially when you process that 50,000 threshold, that's when you get like much better quality advice. But the key thing is this, like if you took away nothing from this entire like chat, it's this, like whoever your advisor is, they need to have a really good ability to explain stuff to you. And so our mentor calls that like the heart of the teacher. So the best advisor is the kind of person who can explain something to you, and then you're empowered to make your own decision for yourself. That is the best kind of advisor who can explain the pros and cons, the risks and those sort of things. Because at the end of the day, they're trying to know your situation so they can make a recommendation, but you know your situation the best, better than anyone else, right? And so that's the kind of advisor you want, someone with the heart of a teacher who's just going to explain the pros and cons in a very neutral way and in a communication style that makes sense for you. So that's probably where I would start with that.
Yeah. I'll say one more thing as well. Find someone who looks to seek to understand your situation fully. There's no one size fits all recommendation, but rather someone would need to fully understand, what's important to you. What does your current situation look like? What are the gaps that are currently in your plan to get to your goals? And so in order to do that, you would want someone who really cares. The other thing too is if you would like some recommendations to other advisors, I'm happy to make some recommendations as well. So that's the only other way, I guess, is just through really good word of mouth. Yeah.
Good point, that G. Cool. Our next question here is from Claire Provenzano. What a nice name. If we go to our bank's financial advisor, will small cap value be an option to invest our TFSA or other money in? The short answer to this question is very likely no. Some companies have something very similar. They call it a small cap value fund, but it's completely different. Okay, so they might say that they have it, but it's a very high probability that they don't have access to it. Yeah, so Claire, that's where you would basically say when you hit that $50,000, that $100,000 threshold, that's when you can access like a private investment manager, and they can access that for you.
I will also say, also say, if you ever want someone to look at the portfolio just for a second opinion, you don't even have to work with us, but we get these kind of messages a lot, like, hey, is this actually a small cap value fund? Can you take like 2 seconds to look at it? We're happy to do that as well. You don't have to work with us or anything. Yeah, Jacob and I, we just genuinely want to just make sure people feel like they're well taken care of. So if you ever go to a bank and they offer you something, you're not sure, then feel free to just email it over and I'm happy to give you my opinion.
Yeah, great point, G. Yeah, like G knows my story. Like my dad, when he passed away, like we got wrecked by some people, and yeah, it stung us real bad. So yeah, it's very personal for me personally too. So
that's
definitely feel to reach out. Like
I've also had such bad advice as well in the past, and it's just if there's someone else who could give me a second opinion, that'd be great. And so we would love to be that person. So that's really it comes from our personal experience. Yeah.
Next part here is Aishwarya asked, is there an MER for small cap value? You bet. So it's kind of like an index fund though, so it's relatively lower. So I think the ones that were mentioned in like the Paul Merriman and Ben Felix, they range between, I think it was like 0.15% and 0.35%. So around there. So they're relatively very low. Yeah, the average mutual fund in Canada is like 2% for MER, right? And so yeah, their MER is relatively much lower. Does that answer your question, Aishwarya? And our job?
DFA, by the way, also has MERs, but also ranges around 0.25% or so as well.
Yes.
I
actually had a question here from Scotty, a really good question.
Jordan, so just going to pause you for just a second. That's okay.
I
just want to make sure that answered her question, his or her question.
Oh, she said
not bad. That's cool. Yeah, they're definitely more than not bad. Yeah. That's good. Some of the lowest in the industry, actually, which is very good. Sorry, Jordan. Keep on going there.
Yeah, I had a really good question here from Scotty. Scotia, sorry, Kevin, Sue. Given the volatility of small cap value, is the buy strategy to enter the market in tranches over a longer period of time or at one time lump investment?
That's like
Great question.
That's the question about dollar cost average versus lump sum all at once.
You can go first if you want. You got to pull up a
Sure.
citation.
Andrew Hallam talks about this. It's Andrew Hallam, right, Jacob? You have, I think you're pulling up the slide. I know you're pulling up.
Yeah, you got it. You got it.
So when it comes to dollar cost average, which means you're gonna invest consistently over a monthly, like just consistently, steady, slow and steady rather than all at once. There's emotional positive components to this, because if you put it all in at once, then what happens is if it just tanks 60% in a single year, then all your money, you see it tank 60%. Versus if you had eased into it month after month, then it's easier to swallow that 60% dip. And so most people like to do the dollar cost averaging strategy just for that reason. However, there are studies that show if you did invest it all at once, because you do have exposure to the markets as fast as possible, there's a slight little increase in terms of your expected return. It's not a significant increase, so maybe it's not worth it for your emotions and for your well-being, so you can sleep well at night, because personal finances are very personal. I don't care just about how do I get the most amount of return possible. No, I care about how do I hit my goal. And so if I'm going to invest all my money at once, and that's going to cause me to freak out and sell my investments, that's not the way to go. Maybe it makes sense to dollar cost average, versus if you're someone with an incredible iron stomach, maybe it does make sense to just go all in at once, give exposure to the small cap value, and there's a slightly greater expected return because you've given it more time to have more exposure to small cap value.
Great answer, G. Yeah, I've got the citation here as well. So this is a book that's very famous, and it's just a screenshot here. And let me know if you can see it, G.
Is it Andrew Hallam? I think it is.
Can you see my screen, G?
Yeah, I see it.
Yeah, okay, cool. So down here you can see like basically 67% of the time, it makes more sense to just lump sum that money. But okay, that's just pure statistics. It's not personal at all. So like G said, really depends on each person's situation. And what we find is psychologically, it makes people a lot more comfortable getting in pieces, in tranches, as you said, because psychologically, if you end up getting in at the very top and then like you have no more bullets left as the market's falling lower, then you're going to be in a lot of trouble. So if someone's not like has totally no idea what to do, you can always put 50%. And what's cool about that is that no matter what, you're going to be right. So if you put in the money and it goes higher, you say, hey, you know what? I put some money in, and so I did the right call. I put some money in, and I can put some in more later on. And if the market goes down, you can say, hey, I put some money in, and I made the right decision because I can still buy some lower, right? So psychologically, it's a lot easier if you do it that way.
Yeah, time in the market beats timing the market. There's no way for us to know when the best time is to get in.
Yeah, exactly. And so, yeah, let's go to make sure that was okay for Kevin. And hey, G, we're really over time, but I think it's fine, right?
No, it looks like people are still sticking around.
People are sticking around, so it's good. Yeah, well, I'll do it still. Yeah, I've got a question here from Yunha Ku, but I want to make sure that Kevin, did your question? I want to make sure that was okay. I think that was Kevin that answered the question, right?
Yes.
Yeah, okay. Yeah, Kevin, let me know if that was unclear or anything was, if that answered your question directly.
Oh.
He might just be typing. I'm not totally sure.
Yeah.
Yeah, we'll just keep on going,
Yeah,
and
we'll
then
keep going for now.
reply.
The next question, the suggesting to invest in individual small cap value stocks. Is that the next one?
Oh, sorry. So I'm here.
Hello.
I think my first question was already kind of answered.
Okay.
I think you were mentioning ETF for small cap.
Yeah. Talking about when it comes to individual stocks, it's very, very hard to know which ones to pick. It's like picking a needle in a haystack. There's different studies out there, and I think Jacob's itching to show some stats. It's up to you if you want to show them. It's up to you. Yeah, but it's very difficult to predict which individual stocks are the right ones to pick. So it usually makes sense to diversify and hold a number of different holdings. Have a bunch of friends out in the ocean fishing for you rather than just having one person at the lake.
Yeah, that totally makes sense.
Okay, did that answer your question? I'm sorry, I'm probably pronouncing your name wrong.
No, it's Unha.
Okay.
Yeah, that answered my question. I actually had a second question, if you see here.
Yes, okay.
Between the US and Canada small cap value, which do you recommend to invest in? Both. We don't know whether the US or Canada will outperform. Therefore, it makes sense to invest in both.
And actually, we would take that even a step further, and we say, why not buy stock at US and Canada, why not own everything around the world, right? Because if something happens to North America, then your entire portfolio is toast, right? Which is unlikely, but if you guys want to have that more global diversification, then you can own everything, right?
Actually, Jacob, I think
Right.
it would be really valuable to just show how difficult it is to pick the right individual stocks. Do you want to show Best Binder?
Yeah, okay, that sounds
Do
good.
it. This is like our favorite thing. The Best Binder
Yeah.
2018 study from Arizona State University. It's so interesting. So check this out, you guys.
Okay, let me just find it here. So for most people, they like picking individual stocks. So this is like something interesting that we like to show some people. So the first one is this, like, what is the point of picking? Oh, it's super.
By the way, see all these slides? Jacob is the biggest nerd. If you ever want to book a time with us just to ask about these things, we would love to share. Like, it's kind of like, I'll just say this real quick. It's kind of like, imagine you love basketball, and then all of a sudden your friend who hates basketball asks you, hey, can you show me how to shoot a free throw? It's like, I will show you how to shoot a free throw anytime. This is what I love to talk about and do. And you want to learn from me? Great. Let me show you. So seriously, ask us anytime. We're never too busy for questions. That's all. So Jake, go ahead.
Yeah. We're always busy, but we'll make time.
Yeah, that's right. That's right.
So this is interesting. So what people don't realize is when you pick an individual stock, right? Like what is the reward of picking an individual stock, right? And so also, and what is the risk? So what's interesting is that most people, if they were to invest in a normal investment index, they're trying to say, hey, like if I invest in an index, maybe the returns about 10% per year, right? What would make it worth it? Like what return would make it worth it to get individual stocks? So sorry, to pick individual stocks. So like if I need a 13% return, would that be enough for me to pick individual stocks, right? And so what's really interesting is that if you look at all the stocks in history since like 1928 or something, I forget what the data set is.
It's 20
here.
Yeah.
Basically what you find is that only 0.2% of the stocks in the US at least have meaningfully beat the index. So here's like the top 40. You can see on the right-hand side here. Go full screen. So when you're picking individual stocks, a bunch of these companies, like on the right side here, these are the only companies out of like 20,000 companies in the US that actually meaningfully beat the index. And if you take the top 50, I got cut off here a little bit, right? Their average return is about 16%, right? And so that's really interesting because if you want to meaningfully beat the index, like, yeah, wow, 16% per year, that's really good, right? But you have to be really good. And if you were this good, you would own an island, right? If you could own the 0.2% of stocks. And this is my job actually in the past. Some people don't know that. My job was an equities analyst. My job was to pick that needle in a haystack. And yeah, that's all we did. So my mentor Lee, like he manages about, anyway, that was our job. Yeah.
I'll say one more thing as well. So we can see it's really difficult to know which stocks are really good and meaningfully, as in like maybe it gives us a 16% average return per year. But the other, what is it, like 96% of them trail like a 1 month T-bill. So it does, like a T-bill is a really safe investment. And so if you choose wrong, the impact is really big. You will underperform the market significantly. So the odds of you picking the right one are low. And then the risk is you pick something that really just brings your portfolio down if you want.
Yeah, I got that here, G, actually. So about, you guys may not know this, about 40% of stocks that have ever existed, they drop by 70% and they never recover. So think about that for a second. Like if you're saving for retirement, like real money, like for a house, for retirement, anything really major, your kid's education, and you have a 70% chance, sorry, 40% chance of never hitting that goal, right? I don't know about you guys, but those are some pretty bad odds, right? So here's your little reward, your 0.2% probability, and your risk is, 40% probability, right? So financial planning is not just about making the most amount of money, but it's making the most amount of money with the least amount of risk and also the least amount of stress. And so, yeah, Unha asked a really good question. We would almost never, actually, for me personally, I think about this, but pretty much never recommend picking individual stocks. Yeah. There's a time and place for it, but it's fair.
Am I able to add in with this a little bit too?
Yeah, sure.
Yeah, Jordan. Yeah. All right. Yeah.
Even if you don't end up listening to Jacob and G's advice, and you do want to go pick up individual securities, you also got to be very careful with having to pick businesses at the top of its business cycle, where it could be like, producing like high amounts of earnings at that current time. But of course, that could just be a very gracious period for them. And it could always come down and end up, dropping quite a bit, like 70%, as Jacob said.
Very nice, Jordan. Yeah, exactly. And actually, in case you got curious, here's the specific stats that Jordan's talking about. So in each industry, you can see how much, and we've actually spent too much time on this, so let's wrap it up here. But basically, yeah, you can see here specifically by industry, how much of the time that people kind of lose their money for the long term. Yeah. And actually, that'll be all for this slide, because that'll be too much
I think that's
information
good.
otherwise.
Let's move on to the next question.
Yeah, that's enough. Yeah. Great question, Yunha. I will have to leave it there for now.
All right, let's see. What's the next question?
Cool. Everyone's still here. Wow, holy smokes.
Yeah, that's crazy
wow.
to me.
Yeah.
Yeah.
We're almost done here. So there's I
actually
got a lot
had-
of private messages actually, G.
Jordan,
I
go
had a
ahead.
question here. I had a couple of questions here regarding your previous recordings of this financial literacy
Are
workshop.
these just your own questions you're just making up on the spot?
Yeah.
Like,
No,
oh,
I got these
another
from,
anonymous question
Closed.
from
yeah,
Corded
I got some
Joe.
anonymous questions here. Yeah, are they able to access some of your old financial literacy workshops?
Of course, we'd love that. Yes, yes, yes. We have all our workshops are completely free. We have recordings. We even have like worksheets and resources, budget spreadsheets, all these sort of things. For
Yeah,
the
it's
most
all free too,
important
by the
things.
way. It's just
All free.
we just put it there.
So
Yeah.
let us know somehow, get connected, and then we'll send those over.
Yeah, great question, Jordan. Wow. So good. I got another private question here. How do you feel about robo-advisors, example, Wealthsimple, and is there data on their performance compared to real advisors? Oh. Okay. I'm going to ask this one first, Gene. You can jump in if you want
Yeah,
to.
you can go
So this is a great question. So robo-advisors, as you guys saw that progression, right? Like first you start off with mutual funds, and you go to like S&P 500 index, then you do like Wealthsimple, for example, like robo-advisor, and then you go to, small cap value, etc. Robo-advisors, and this is a very opinion question, I would say is fantastic as a baseline. Like when you're definitely starting out and you want to keep things simple, they're really good because of two reasons. First thing is when you put your money into a robo-advisor, it's all automatic. So every time you get a paycheck, it goes into your account and then it goes into your investments. So it's like all automatic. It's like you don't need any discipline because it's all done for you. That's why I really like robo-advisors. Okay. So another good strength is that they're globally diversified and they own a lot of different companies and the fee's pretty low. So all those different things are really good pros for robo-advisors, right? One thing I will say that's not so great about Wealthsimple now is they used to be really good. I actually got the chance to chat with Mike Katchen, who's the CEO, and I don't know why he made this change, but what he did was they started doing active management later on. So you can see like they actually own some gold in their portfolio. And if you guys ever track gold has like a long-term return of like net zero. So after inflation, it's like 0% return. So it just doesn't generate any value. Like it's just like a part of the portfolio that exists. So they do a few things here and there that are not based off of evidence data, but as a whole, it's still pretty decent. So those are kind of the pros and cons. And at the end of the day, like how does it actually apply to your situation? And so this person who I will not name because it was anonymous, I would say like Wealthsimple and stuff, really good place to start if you know what you're doing enough. But once you cross that 50 or 100K, you can make a lot more impact on your long-term stuff if you upgrade later on.
I'll add on to that as well. You get less choice as well. So let's say it's really convenient though. That's probably the biggest emphasis. It's really convenient and it just does a lot of things for you. Once you do get to that 50K investable assets mark though, you have more control. So in the sense that you could invest in things that are more aligned with your values. So if you're like concerned about fossil fuels, then you can do something like ESG funds. So environmental, social governance funds. These like screen out companies that are really harmful for the environment. If you're an evangelical Christian, you can invest in biblically responsible investments, so BRI, for example. You don't have too many choices, I believe, with robo-advising when it comes to aligning your values and your investments. So that's just another small note.
Nice. Did that answer your question, anonymous person? If you would just speak up or send me a message to follow up with that. And people just keep on going for now.
While we wait, we can look at the next question.
Yeah, okay, that sounds good.
Is this a good year to enter the small cap value market? There's no way for us to know. If anybody tells you whether or not the market will react a certain way or it'll go a certain way, I need you to turn around and run as fast as you can. Nobody has this crystal ball. If anybody knew, they'd be a trillionaire, right? They would know exactly what to buy and when to buy it. And so for us, we have no idea. But if your time frame is 20 plus years, then it doesn't matter if it drops tomorrow, if it drops 10 years from now. But we do know it will drop. Markets need to breathe. It's like a rubber band. You can stretch it. It's going up. It needs to snap back into place. That's called a market correction. And so whenever that happens, you'll have a good advisor to help guide you through that situation, but you had a plan in place on day one, which is to invest, consistently invest, stay invested. Markets will come down and up, but there's no way for us to know whether it's a good time right now or not. The best thing to do is just invest early and keep investing.
And did that answer that person's question? I just want to make sure who asked that there.
Oh, Aishwarya and Arjav.
Oh, yes. Okay, perfect.
Thanks so much.
That's good. Okay, perfect.
Are crypto
also got-
stocks a fluke?
Sorry, G, I was going to say the
Sorry,
last
go ahead.
person who asked the previous question that was anonymous said they're good. So that's
Okay,
good.
perfect.
Cool. They're considering moving away from Robo 50, 100K. Perfect. So yes, so next question is, are crypto stocks a fluke? Sorry, this might be out of scope for this workshop, but I'm very curious. Depends what you mean by a fluke, I guess. Can you elaborate on that a little bit, just so we can understand your question a little more?
Like, are they worth investing?
Oh, gotcha. Let me think about how I answer this question.
You can go first. I have my thoughts.
Okay, you go first because I want to think about it. Yeah.
Okay. Well, when it comes to my important money, I want my money to do what I expect it to do. And so I want to use Nobel Prize winning literature to make my claims. You know, when I make an investment, I'm making a statement, like I mentioned earlier, and I'm making a statement based off these Nobel Prize winning literature. So I know that having a globally diversified index fund, markets every single time in history have bounced back every time they've gone down, and they've bounced back more up than they've gone down. And then I also know that there are several different characteristics of stocks that tend to allow to do better than other types of stocks. So I'll invest that way. When it comes to scratching the itch of speculation, this makes sense. This could be kind of fun. Then personally, I'll put in less than 3% of my net worth towards scratching this itch. I know it's irrational. I know I'll probably lose just looking at the statistics of it all, but it's still kind of fun. So I'll make sure I have money that I expect to burn, and I'll just have that as a play account, but no more than personally 3%. People have different thoughts on how big your burn account should be. Jacob, what are your thoughts?
Yeah, that's good. Yeah, I think I want to mention here is like me and G, our job is to if you live at like 999 lifetimes or 1,000 lifetimes, sorry, we want to make sure that you're successful in 999 of them, right? And so when you make decisions, we want to make our decisions based on proven processes that have worked in the past, right? And I will say crypto is not one of those proven processes. And so I would say, those are some good pros and cons that G mentioned, but I would say personally, I own 0 crypto. Okay. Yeah, just because our job is to make sure that people hit their goals, they hit retirement, they can provide for their kids, right? If you're investing in crypto, right, you're here today and then your kids are out of school tomorrow, right? You're out of a house tomorrow. So is it worth it? For some people, but certainly not for I guess, if you have a family and those kind of things. That's your question, Aishwarya?
Yeah, thank you. The reason I ask is because even with individual stocks, we've seen a lot of pump and dump things happening around,
yes.
especially in the past year. So it's really concerning the way that people are playing with their money, especially right now, with the inflation stuff. So I was really curious, is it too risky, just like crypto, because it's tied to crypto, or does it have support backing it? Because it's on the market and it's on the stock market, right? So
gotcha. Yeah, exactly. Yeah, at the end of the day, if you don't know what you're investing in, it's probably the wrong investment. So yeah, that'll keep you a lot safer in the long run.
sure.
Yeah, great question. Gee, you don't have time. I gotta go eat dinner, but I'm okay. Just this.
I can keep going personally.
Okay, the queue's trickling in, but I'll just stay. Let me just see here.
Does it make sense to keep buying into an equity stock such as an ETF, even if the current price is much higher than my average buying price? Depends what your goals are. Depends on your time frame. You would actually hope that the ETFs are higher than when you bought it in, right? Imagine you bought it 10 years ago, then you would hope that it's higher now. Do you continue to buy it into it? Well, if the time frame is another 10 years away or so, then it absolutely makes sense. A globally diversified index fund, we expect it to continue to go up. So it depends what your goals are, depends on the type of investment you're going into, but ultimately, yes. And again, we also don't know when the best time is to get into the market. If you try to time when to get in and you miss out on the best days, then that can be very painful to your overall stock returns as well.
Jerry, does that answer your question? In the context of investing for the long term? Yes, it does. Okay, perfect.
Okay,
yeah,
perfect.
it's a very
If you're trying to wait for it to come down, it's like, when do you know when it's going to come down? When do you know when the bottom is? And then you happen to miss the best day in the last 20 years. And then all of a sudden your returns are significantly less, right? So time in the market beats timing the market. I think I've said that like 4 times today. So that's good.
Yeah.
It's good quote.
Hey, Jordan, someone asked a while ago about like present data for 2023 or something, right?
Yes, from 2013 to present date.
Okay, yeah. Do you know who asked that by chance?
That was Scott.
Scott, great question by Scott. I hope Scott's still here. I can't tell, but
he is not here.
he is not. Okay, Scott, this is just for you, my man. If you're watching this later on, so if you are a dimensional advisor, you get access to the full data set. But if you're not actually, I have it loaded up here. Look at that. If you're not a dimensional advisor, you can use this website. It's not as good, but it's not bad. So this company called IFA.com is like indexfundadvisors.com or something. And what they do is they picked a global index and they owned a little bit more of the small value companies. And so if you go down here, you can see like right here, I believe. Yeah. So here's like 1930, January 1st to 2023. You can see small cap value right here. You can see it at 13% compounded return between 1930 and 2023. So there's some good updated data that you can use, and you can see the citations all the way down here. In case you're a nerd like me, I have gone through this too. So Scott is not here, so unfortunately we can't go into that today. Done for everybody else who's here today. But basically that's where you can find some more updated data for the average person, but you can access the data through Dimensional if you are a Dimensional advisor. Hopefully that answers this question.
Yeah. If you haven't noticed by now, Jacob is a massive nerd, and that is.
I have saved every question for the last 8 years. Yes. This thing. So yes.
This guy.
Okay, I think we're the last question, G. Unless Jordan, you got any private questions there?
Yeah, well, I had a question here from Caitlin. When will the next workshop be?
Oh yeah, that's the best
us a chance
question
to
ever.
Recover a little bit. We'll get on it right away. Personally, I'm going to be doing workshops for different types of professionals, whether it's physios and doctors and dentists. But when Jacob and I do one together, we really put our heart into it. And so expect, I don't know, what do you think? Spring, man, summer, something like that?
No, we'll see. We'll see.
We'll see.
I don't make any promises.
No
promises. A lot of the stuff we do is private, right? So yeah, we just rarely get to do something public like this. That's why Theory here, our main man, love seeing you, man. So it's good.
Yeah, that's right. Okay, awesome. Any other questions on your end?
Last one here. Sorry, Jordan, is there anything else that's private there?
No, we're all good on my
So
side.
Aiden asked, are there any small cap value ETFs on TSX rather than NYSE? There are no Canadian listed small cap value ETFs, at least as far as I know. Jacob?
There is one that looks like it is, but it's not. Yeah.
You mean the Vanguard one?
Well, there's a few of them that kind of look like it.
I guess there's a few that look like, but they like, I personally wouldn't invest in them myself, kind of thing.
Yeah, I mean, there's a reason why we don't touch them. Yeah, because they're not true. Like people can say there's something small in value, which means that they are like, smaller and value based. But if you look at like what's under the hood and actually like break down the engine and see what's inside, you're like, hey, this is not small. This is not value. This is not even close. So, just the title slapped on there doesn't mean it's actually the case. That's why I think Graham asked a great question earlier. Like this ABEM, is this actually small value? And you can go inside and you can see the rationale. So great question, Aiden.
So the answer is no, unfortunately.
Yeah. Okay, that is good, man. Is that everything? That would be every question for now. Yeah. So thank you guys for hanging on to the very end. Wow. We appreciate you guys asking such great questions. Yeah, it was so nice. Good to see you, Kent. Thanks for the
thank you, Kent.
True value. Thank you for that. That's we literally brought value today, small cap value.
Yeah,
we appreciate that.
2 types of value, hopefully.
Yes, Samson, thanks. Noel, good to see you. Serena, Priscilla, thanks guys. Jerry, Maya, Prasado, thank you so much. CC, through 11 out of 10, thank you, brother, just for you. Emily, thank you so much. Aiden, Hannes, hey brother, thanks brother. And
keep your eyes peeled for the winner of the the survey as well. We'll be announcing that very soon. But thank you all for attending. Yeah, this was a lot of fun for us.
Yeah. I'm surprised how many people stayed on. It's quite
good. There's a lot of people stayed on.
Have a good one.
Hey, thanks.
Yeah, thanks, Peter. Good to see you, man.
See ya.
All right, that's good. Are we gonna start the recording, G, or?
Sure.
Yeah, okay.
Oh, I cannot.
You
Well,
can.
okay, it was recording. I was like, it wasn't recording. Okay, so let me pause that.
Okay.